All right, hello, I'm Eric Zachariah, and I'm representing my team to discuss our trading day algorithm. Here's a quick overview for this presentation. First, I'll talk in detail about our momentum algorithms pipeline, from how we pick the stocks in our portfolio to the actual trading strategy. Next, I'll discuss how we used a benchmark momentum algorithm to help us validate the decisions that we made for our custom momentum algorithm. Then, I'll review the results of our algorithm across a few different time periods, following that by highlighting areas of our group's creative thinking with ideas that differ from prior weeks. Then we'll touch on the meticulous process of building our algorithm, followed by some of the insights we learned in the process of trial and error backtesting. And finally, I'll pinpoint the primary focus of our strategy and how we would continue improving upon it if we had more time. So to begin our pipeline, we ran an experimental backtesting algorithm in a separate file to strategically pick our basket of stocks. We had to separate this stock picking file from our trading algorithm because we wanted to algorithmically pick our basket of stocks that met our criteria over a period of time, which was doable through backtesting. This method we used to pick our stocks simply didn't exist in the research notebook, and backtesting without actually making any trades did the trick for the purpose of picking stocks that had the best fundamentals over an extended period of time that we specified. We wanted to focus on a fixed basket of stocks instead of the entire universe of stocks because we thought that our momentum strategy might perform better on stocks more influenced by the momentum strategy. We also needed to avoid picking new stocks from a universe each trading day because our momentum strategy requires us to keep track of a sliding window average for each stock in our basket from day one. So using this predefined basket of stocks allowed us to compute the window average for each stock from the very first trading day instead of rather whatever day a new stock might enter the portfolio from the universe. So before jumping into picking stocks algorithmically, we actually researched sectors that have historically performed well in November, especially those that showed signs of increasing in price due to momentum trading, after which we used our backtesting technique to pick the stocks from the universe, the universe that fit into these sectors. So first we filtered the universe down to the top 500 stocks by volume, trading for at least $10 per share. And then we segmented the stocks that fit into our 5 preferred sectors, dropping stocks from all other sectors. After which we selected the top 30 stocks with the highest free cash flow to price growth ratio and kept a counter for each day that the stock met this top 30 criteria over a period of the past month. And finally, we picked the 30 stocks from each sector that developed the highest counters from that counter to contribute to our diverse basket of 150 stocks. Next, we implemented our trading algorithm based around this basket of stocks. We really liked our momentum strategy from a prior week, so we decided to improve upon it. Our definition of momentum was derived from the physical definition of momentum. Much like a train traveling at a high velocity, it is difficult to stop a large mass of investors from hopping on the bandwagon when a stock's price is on the rise or falling. So walking through our derivation, we use a stock's daily traded volume to represent the mass from the physical equation, and we use the stock's daily change in price to represent velocity. We also divide both the volume and the change in price by a sliding window average as an attempt to minimize any intraday market bias. Additionally, we multiplied this initial momentum derivation by the inverse of a stock's volatility, since in some sense momentum is the opposite of volatility, such that a momentum trends in one direction, depending on how you look at it, such that its price steadily travels up or down, unlike a volatile stock that more aggressively travels up and down, depending on how you look at it. And therefore, multiplying our momentum by a stock's inverse volatility adds an additional measure of certainty to our momentum trading signal. As a benchmark, we built another algorithm, momentum-based algorithm for comparison. In this strategy, we used the same coarse and fine universe selection filters to select our stocks, but in this case, the universe is changing on a daily basis based on the selection metrics. To account for this change, we employed a simple momentum definition that doesn't require a sliding moving average, where momentum equals the closing price of a stock today minus the closing price of a stock n days ago. We played around with different look-back periods, which is what n represents, and the number of stocks to buy, and found the best results when we would buy the top 20 stocks with the highest momentum each day, and a relatively shorter look-back period around 3 to 4 weeks. Shorter and longer look-back periods than this performed very poorly, actually. The best performing configuration of the strategy yielded a 29% net profit, which turned out to be less than our custom momentum definition's return, which is a good thing. And this indicated to us that each of our decisions that we were making while moving forward each time with our custom momentum definition was moving us in the right direction because the returns kept improving. So we back tested our algorithm over various periods with a little bit of focus on November. Our 6-month periods date back to 2016 and always include November. We included 13-month periods instead of 1 year to double our insight on November performance, dating back to 2016 as well. And finally, we included some 3-year, 1-month periods to see how our algorithm might perform over a longer time frame with a little more historical context dating back to 2010. So here are our results. Overall, our algorithm performed pretty well, and it was really interesting to see consistent positive returns in the month of only November with really impressive probabilistic Sharpe ratios. And this occurred all the way back to 2016 is how far we checked the 1-month returns. So we took some novel approaches to ensure that this algorithm performs well in the coming 3 weeks and is different from our original momentum trading strategy. This time we placed a lot of focus on tailoring our algorithm for November trading by only choosing stocks from sectors that have historically done well in November. We implemented our knowledge of valuation metrics and chose the free cash flow to price growth ratio because we thought those stocks would more likely benefit from a momentum trading strategy. We gave ourselves the option to choose between using an exponential average or a regular average when calculating the sliding window averages for changes in price and volume. Our optimized algorithm ended up using the exponential average, which just produced better results. And it's different. We didn't use the exponential average last time. We also improved how we calculate volatility to make our algorithm more robust. We can now choose from different ways of calculating volatility from the original linear volatility that we had previously defined. The standard deviation volatility is calculated using the standard deviations of prices. The conditional variance volatility is calculated using the standard deviation of the magnitude of minute-by-minute price changes. And the fast Fourier transform volatility is calculated by transforming the array of prices to the first it initially finds the frequency and power of each price, and then it uses this information to create a score that penalizes higher frequencies and higher powers. We observed similar results and trends using the prior 3 definitions, but the FFT definition resulted in a very different return graph that didn't catch the longer-term bull market as easily as the others, but it did produce higher returns when the others performed poorly. So we actually like this option the best because we're more interested in not losing all our money if the market goes south, but we think that we'll probably still do pretty well if the market is bullish. And that thought, of course, ties in nicely with some of the process and learnings that we experienced. The process of building our algorithm is difficult to measure in terms of iterations or revisions. It was definitely more of a steady flow of ideas that would translate a few different ways into code, and then we would experiment with the results using different time periods. Usually the analysis from these experiments sparked better ideas because we were usually left wondering things like, why does this consistent dip occur during a period that wasn't bearish? Or why does this strategy work opposite to how we pictured it? This curiosity caused us to invent new ways of calculating volatility and the momentum sliding window averages and resulted in a battle-tested algorithm ready for the next 3 weeks. After observing how our algorithm performs, we noticed some consistent performance dips during periods that we couldn't explain. As a team, we don't really like dips in the performance of our algorithm's portfolio, so we tried a slew of strategies to mitigate these dips. We tried backtesting using the different volatility definitions that I mentioned earlier. We tried biasing the weights of allocations to buy more of the stocks with higher momentum, which turned out to be a very good decision. We experimented with changing the importance of the inverse volatility in our momentum definition to see how that affected the buy and sell signals. We experimented with price drop limitations such that our algorithm would liquidate when a stock's price dropped past a specified threshold. We added the option to use shorting strategies, which we decided to leave out from our optimized algorithm because while the shorting strategy did outperform the long-only strategy at certain points in time, the overall returns were not as good within the time periods that we tested. Shorting amplified both the gains and the losses that we saw. Finally, we added a max holding period for securities in our portfolio so we can maintain a certain liquidity to trade other high momentum stocks, but we did not notice much of a difference with different max holding periods. So in summary, we observed that methods C, D, E, and F did not help much in terms of returns, while A and B consistently yielded very clearly better returns. So I've already said it a few times, but I'll say it again for the purpose of this slide. The strategy that underpinned our algorithm was focused on optimizing for momentum in November. We handpicked the fundamental growth metric that filtered stocks into a basket for the purpose of momentum trading. We then continued to optimize our algorithm to mitigate risks during bearish markets, which we believe contribute to our higher probabilistic Sharpe ratios. And we noticed a need for improvement in our sell-off timing. Currently, it is not independent across stocks. That is, we may prematurely sell stocks because we need to make room for other stocks. Ideally, given more time for implementation, our algorithm would decide to buy and sell timings for each stock independently. Our fast Fourier transform volatility definition generally performed better than the other three methods, but we believe this actually changes based on market conditions. It would be really interesting to see if we could automatically switch how we calculate volatility depending on the type of market that we're in. And that would be done by maybe adding in some indicators to indicate that we may switch our volatility definition based on whatever conditions or criteria are met. And finally, we're really excited to see how our battle-tested algorithm performs over the future 3-week period. From using our new and improved momentum definition to validate our thoughts with an additional benchmark algorithm, we're confident that our risk mitigation algorithm will produce positive returns. Thank you.